Hello, everybody. This is Toni Turner, and welcome to the market now as of Friday, May 22nd at about 3:30 p.m. Eastern. Before we start, please know that all of us at ToniTurner.com wish you and your loved ones a very safe and very happy Memorial Day and Memorial Day weekend. Please remember also the markets will be closed on Monday. And now on to the market. U.S. stock indexes moved in a flat to low to negative range today as investors gauged China-U.S. tensions amid continued uncertainty over the pace of economic recovery from the coronavirus. The main indexes are still set to add between 2.8% and 3.1% for the week on optimism over a vaccine and the easing of virus-related curbs. And on that pretty good note, let's move on and look at three charts that could give us some insight into the week to come. First of all, as we always do, we're going to look at a daily chart of the S&P 500 SPDR, symbol SPY. This is the exchange-traded fund that closely follows our benchmark S&P 500 index. Now, when I captured this chart today, the SPY was trading right here, if you can see, at $294.71 since our all-time closing high on February 19th at $338.34. The SPY is now trading at 13% off its highs, so it's still in correction territory, but thankfully out of bear market territory. Now, the benchmark has fought all the way back very, very nicely, and we may have to move this trend line around a little bit. 20-day moving average is doing a pretty good job, but it's still making higher lows, and that's what counts. It's fought its way back after touching lows down here at 218 or about 2180 on the S&P 500 itself. It's fought its way all back up here, or back all the way up here, I should say, and then traded sideways or in a range for about 3 weeks right in here. Then on May 14th, made a dumpster dive down to here. It almost went down to the 50-day moving average, but note how resilient the S&P 500 is. The buy the dippers came in, and the SPY jumped back up into its trading range and a tiny, tiny bit above that. So again, when I captured this chart today, the SPY was trading at $294.71. That's about $29.47 on the S&P 500 itself. Now, overhead, as you can see, for resistance, the S&P SPDR has the 200-day moving average. The black line is the 200-day moving average. That can be a tough dude sometimes and offer pretty strong resistance. The good news is it's moving sideways, and many times when this moving average is moving sideways, it doesn't act as quite such strong resistance, but it is up here for sure. The SPY will have to get through it, and it's coming in now at $299.55. or about $29.95, I should say, on the S&P 500 index. We can almost think here of 3,000 on the S&P 500 as acting as resistance. Now, if we look down here, the 20-day moving average, the red moving average, that has acted as a pretty darn good trend line overall for the SPY. So it's coming in today at 288.94, and if the SPY has to take a little move south here to get another running start, the 20-day at about 289, we'll call it, could act as resistance. We also have support down here at about 277, and of course the 50-day moving average oftentimes lends support, not always but often, and at the moment that's coming in at $272.48. So if the SPY can't climb over the 200-day moving average next week, it does have quite a bit of support here in price support and moving average support that it could potentially keep it up where it is. From our lips to God's ears. So as always, though, we're in this kind of a let's see what happens mood, so please do keep your protective stops in place. Our next chart today is going to be the Invesco QQQ, symbol QQQ. As you all know, this QQQ represents the NASDAQ 100. Of course, that's a major index in the stock market. As you know, its holdings represent the top large cap momentum stocks like Amazon, Apple, Facebook, Alphabet, Microsoft, Intel, that whole group. So it's a very important index that we do watch closely. And its all-time high was back here on February 19th at $236.98. And today, when I captured this chart, the QQQ was trading at $229.11. So it's done a really good job of bouncing off these lows. It did fall down to this low down here and on March 23rd, down here around $160, then bounced up. And the high momentum stocks, the tech stocks, has really been pretty much leading the market higher for most of this bounce up. Of course, it makes sense. We've been using a lot of social media, a lot of different meetings like Zoom, online meetings. So technology has really come into play here as coronavirus has kept so many of us at home. So the QQQ moved in a really beautiful uptrend here. We can see it. We can see how the red line, the 20-day moving average, has acted as a really good trend line for the QQQ. The only thing I would note here is that now the Qs, the higher highs here, aren't going up at quite the same angle. So I drew a line over the top here to show you this is now, this whole pattern is now turning into, at least for the time being, it's turning into a rising wedge. Now with a rising wedge, we want to be careful. It's lots of fun while it's moving higher, but of course at any time, like anything else, it could break lowers. These 2 points are coming together here. So, and the Qs are only 3% off their prior high up here. So with both of these things, all of this coming together, we could see some resistance up here in the coming week or weeks. I wouldn't be surprised. Maybe not too volatile, but certainly some resistance nonetheless. So you may want to keep your eye on this rising wedge. And I'm going to say here, as long as the Qs stay above the 20-day moving average, the red line, probably in good shape. If they start to move down, or it, I should say, moves down below and breaks through that, then got to be a lot more cautious. Our final chart today is the Consumer Staples Select Sector Spider, the XLP. Top holdings, there are 33 holdings in all. The top holdings are Procter & Gamble, PepsiCo, Walmart, Coca-Cola, and Costco. So if you want to own Costco, and it's a pretty expensive stock at $307 today, this is one way to do it for a little bit less. So at any rate, consumer staples, as you can see, have had a little rougher time here. In this last move up, the consumer staples bounced nicely off of the March 23rd low. Well, let me start at the beginning here. The XLP, the Consumer Staples ETF, had an all-time closing high here in February. Actually, it was on Valentine's Day at $64.79, right up here. That was the all-time closing high for Consumer Staples ETF, the XLP. Then it dropped dramatically, and it dropped down to a low on March 23rd of $47.66. That was a 26% drop. Now, since then, the XLP has rebounded, most certainly. Got about halfway back up that fall. But then, as tech stocks have taken over, they've been a lot more exciting to own than consumer staple stocks especially in the last 4, 5, 6 weeks. As you know, the XLP just kept going strong. Consumer staples have fallen down a bit because they're certainly not as exciting. They're value stocks. Value stocks have not been excelling in the last 5 or 6 weeks. Tech stocks, or growth stocks we can call them, they have been excelling. So Everybody wanted to be in the high moving Facebooks and Teslas and so forth, and certainly can't be blamed for that, and leave the Procter & Gamble's back here in the dirt, so to speak. So after it moved up pretty dramatically into the 1st of April, Consumer Staples XLP fell down here, and then it started walking, kind of drifting lower on top of its 50-day moving average. It's come down here and is trading actually below the 20-day moving average. Now, when I captured it today, it was trading at $57.26, just below the 20-day, which is coming in at $57.75, a little bit overhead there. So, but it is still above its 50-day moving average. So, and we do have to look up and see that the 200-day moving average is coming in. It's horizontal, so again, that doesn't apply quite so much pressure, but it is certainly coming in here at $60.42 at the moment, something we want to be cognizant of. Now, if the large growth stocks get a little rowdy next week, if they are too far over their skis and they start falling a little bit, or if the XLP, and again it's at 57.26 right now, if it moves up and moves up here, it's at 57.26 right now. If it moves up above 58, I'm going to call it, if it moves above 58, I may add a small position to my portfolio, because generally speaking, if growth stocks take a rest and move a little lower, then staples typically move higher. So this is kind of a sector rotation thing, if it happens. But so let's say if the XLP moves up above 58, that's what I'm going to use, and trades above it, I may add a small position of it to my portfolio. My initial stop is going to be down here at $56, which is just under the 50-day moving average. Now, if in coming weeks the XLP can move up, if it can move up and close above the 200-day moving average, again coming in at 60.42 right now, I may then add to my position. And note here that there is also, right exactly where the 200-day is, there is also a pivot point here from by the XLP. So there's price resistance as well as moving average resistance. So if the XLP can get above that, and it'll probably be above $60.50, I'm going to call it. If it does that, I may add to my position, and of course by then that my stop will be a trailing stop. Now, of course, please know, as always, especially in this environment where headlines come at us from all directions, please know that if the market rolls to the downside hard for any reason, I may exit the trade early before it reaches my stop. With all that said, you may want to keep an eye on the XLP in the coming week. And now, please know that I've temporarily suspended my usual list of next week economic reports to briefly touch on the topic below. If you want a calendar of the economic reports, you can go to toniturner.com, click on Education, and then click on Economic Reports. Today we're going to talk about something that I think plagues most traders. So we'll start with a question, as we always do. The question is, when I have losing trades, do I try to get back my losses by either A, adding to the losing trades, or B, placing new oversized trades? Now, when I started trading, I have done both of these things. I've taken both of these actions. So let's look at number one here. Let's look at trying to overcome a losing trade by adding to the losing trade. And that is known, as you must know, as averaging down. So say you bought shares of a stock at $10 each, and now the stock's trading at $5. So you think, oh boy, if I add the same amount of shares here to what I already have, my average price will be $7.50. It will be easier for the stock to come back to $7.50 than it will for it to come back to $10. And if it comes back to $7.50, That way I can get out even and I'll just jump out there. Well, I got to tell you, that strategy, I meant to say, is fine if it works. But what if it doesn't? Because if it doesn't, then you're throwing good money after bad. And please know there is a reason, possibly a fundamental reason, why this stock has fallen by 50%. Please remember that and know that if a stock falls, if your money is down to half of what you had, it takes 100% to get even. So if the company has fundamental problems, it may stay down for a while. So think about that, and then we'll talk about what to do with it. Now, the second strategy is to take on a new trade. And I remember when I was so proud when I thought this up back when I was learning how to trade in New York. I thought, well, I've taken one really hard loss. So what I'll do is I'll find myself a really volatile stock that surely is going to go up from here, and I'm going to buy a whole bunch of it. And then when it goes up, I'll make that trade, I'll get out, and that way I'll earn back the money I lost in my last losing trade. Now, please, please, please know, people, that is another way to lose money. The trouble is, as I just said, we usually use a volatile stock. We usually choose one for this reason that's going to go flying. What we forget, though, is it can fly down as well as up. And so we usually choose a volatile stock. We buy way too much of it. And then we are fearful going into the trade. Underneath it all, we're scared we're going to lose even more money again, and we're scared because we know that we have bought a really oversized trade, far too many shares, far too big of a percentage of our capital considering what our account is. So know that when you do that, you're coming from a mindset of fear, and that can lead to all kinds of choices that can absolutely be detrimental to your wealth. So please, when you have losing trades, back up and look at the big picture. Find where the next level of support is. If it looks like the stock is headed even lower, consider biting the bullet and exiting with a loss. Then, and this may be hard to do, but please do it, study the trade and write down what you've learned. Okay, what have you learned and how can you apply these new actions to your next trades? Finally, when conditions are favorable, meaning yours, your head's back on straight again, and the market, hopefully it's moving in an uptrend, then you can enter one or two low-risk stocks like staples or consumer staples or utilities. Use a definite trading plan and get a little green on your screen. That should help. So please remember, using high-risk strategies to try to retrieve losses is really, really a tactic to avoid. Instead, please always, always, always use a well-thought-out trading plan and stick to it. Mind your stops, and remember that protecting your capital is your most important job. Okay, you all, please stay safe out there. Keep green in your screen. I'm Toni Turner. See you next time, and this is The Market Now.